Today, we are taking a deep dive into Heineken Malaysia Bhd. We want to uncover exactly how a business with shrinking revenue can simultaneously operate in a way that generates such consistent cash returns.
It is a really fascinating operational paradox, honestly. We are looking at a company operating in a highly regulated duopoly in Malaysia, and they trade under the stock code 3T255.
Oh, okay. The data we're unpacking here covers the second quarter of the 2026 financial year, which ended on June 30th, 2026. And I should just add our usual quick reminder.
Of course.
This discussion today is strictly for educational purposes. We are literally just breaking down the research and the business mechanics from this slide deck, so please do not take any of this as financial advice.
Absolutely. We are just analyzing the structural realities of the business model presented in the source.
Yeah. So moving to part one, business analysis, let's start with how this company actually generates its revenue.
Right. So Heineken Malaysia brews, packages, and distributes malt beverages, and they do this predominantly within Malaysia. Their product portfolio includes Heineken, Tiger, Guinness, Anchor, and Apple Fox. But the most critical accounting detail here is how they record their revenue. They book revenue strictly based on what is called ex-brewery sales.
Ex-brewery sales. So let's unpack what that literally means. That means they're selling their physical inventory to distributors and to the trade, meaning bars, restaurants, retail stores.
Yeah.
So the revenue numbers on their income statement, they only measure the physical product leaving the factory loading dock. It's not tracking the exact moment a consumer actually buys a drink at a bar.
Precisely. And that distinction is vital because it creates a time delay in the data. What we see in the revenue figures is the wholesale demand.
Right.
Which can sometimes conceal immediate shifts in end consumer purchasing behavior.
Right.
And that directly leads us into their pricing strategy. So according to the analysis we have, the business executed 3 separate literal price increases during the 2025 financial year.
3 price increases in a single year. Now, just mathematically, if a business raises the price of its product 3 times, you would expect the gross profit margin per unit to expand. And initially, the data shows that is exactly what happened. Their gross margin expanded from 33.31% up to 35.19%.
Right.
But when we look at the financial reality of Q2 FY 2026, despite those wider margins per unit, their total revenue actually fell 19.4% year over year.
Yeah.
It went down to 434.7 million ringgit, and their net profit fell even further. It dropped 39.1% down to 50.5 million ringgit. So my question is, if the business implemented 3 price increases and the gross margins expanded, what literal mechanisms caused a 19% drop in revenue and a 39% drop in net profit?
What you are seeing there is the direct result of price elasticity interacting with fixed operating costs.
Yeah.
Let's break down the literal sequence of events. When Heineken Malaysia raised the physical price of their beverages 3 times, they found the maximum limit of what consumers were willing to pay. So consumer demand softened. Because of that, those distributors and bars we talked about, they ordered fewer total units. The 19.4% drop in revenue is simply the mathematical result of fewer total cases leaving the factory, even though each individual case was sold at a higher price point.
Okay, so that explains the revenue drop. People are buying fewer units, but why did the net profit drop by 39.1%? That is a much steeper decline than the revenue.
It comes down to the mechanics of operating leverage. The factory where they manufacture these beverages has heavy fixed operating expenses. They have to account for the depreciation of the physical machinery, the baseline salaries of the factory workers, maintenance, utility costs.
Right.
And those costs are static. They do not decrease just because the factory is producing fewer units of beverage.
Yeah.
So when your gross revenue is shrinking, but your fixed costs remain exactly the same, your net profit is mathematically squeezed at an accelerated rate. The bottom line falls much faster than the top line.
That makes perfect sense. The fixed costs don't change, so the profit takes the hit. But the report also notes that even with falling volumes, the company still retains a 95% market share alongside its sole competitor.
Yes.
Which leads us directly to part 2, moat analysis. We need to look at their competitive advantages. Because if prices are high and volumes are falling, you would expect a new company to enter the market with a lower price.
You would, but the framework in the report analyzes their competitive advantages and categorizes them strictly as intangible assets.
Okay.
And in this specific context, those intangible assets are regulatory barriers. The Malaysian government exercises strict control over manufacturing licenses and enforces an extremely high excise tax regime. It is virtually impossible from a regulatory standpoint for a new entrant to set up a commercial brewery.
So it's government regulation preventing competition. And because they are in this duopoly with only one other rival, Carlsberg Malaysia, they also possess a low-cost production advantage. Because Heineken and Carlsberg control 95% of the legal volume, they are purchasing raw materials, malts, hops, glass, at massive scale.
A new competitor just couldn't match their per-unit purchasing costs.
Exactly. The scale advantage is massive. However, the report makes a very specific point here. There are zero switching costs for consumers, and there are zero network effects.
Right.
A customer in the store can decide to purchase a different brand or a different category of beverage entirely with zero financial or technical penalty.
And that is what is so interesting to me. The analysis explicitly states there are no switching costs or contracts for the consumers. It's an impulse purchase. But the historical data shows that Heineken Malaysia's return on invested capital, their ROIC, sits at roughly 69.7%, and they have a dividend payout near 100% for over 20 years.
How does a company mathematically sustain a 69.7% ROIC when customers have no switching costs and can change their purchase decisions at any second?
The mechanism there relies entirely on the consolidated duopoly with Carlsberg Malaysia. Because there are only two legal entities controlling 95% of the market, there are zero price wars.
Oh, okay.
If Heineken lowered its prices to gain market share, Carlsberg would simply match the new price. Neither company gains volume, and both companies mathematically reduce their own profit margins, so they do not compete on price.
I see.
But the report does point out that this duopoly structure doesn't prevent all financial degradation. The profit before tax margin, or PBT margin, actually compressed from 20.74% down to 18.58% in the first half of FY 2026. So while the regulatory barriers prevent new entrants from arriving, they do not prevent margin compression when operating costs rise or overall consumer volume drops.
So they have compressing margins and a completely established duopoly where they don't compete on price. This brings us to part 3, long-term growth drivers. Because how does a company physically manufacture new growth in that exact scenario?
That is the core issue. Historically, their growth relied on the proven engine of literal price increases, which we already discussed. They do have new products like Heineken 0.0 and Tiger Crystal, and they run marketing campaigns like the Tiger Town Festival.
Yeah.
But the analyst classifies these only as moderate drivers.
Okay, so just incremental volume from new products.
Exactly. The single largest operational change identified in the report is the commencement of Singapore exports, which starts in the third quarter of FY 2026.
Okay, let's detail the supply chain shift here because it involves the global parent company. Heineken NV is entirely phasing out physical brewing operations in Singapore by Q3 2027. And they are shifting that exact production volume into the existing already built capacity of the Malaysian and Vietnamese facilities.
Yeah.
But since no explicit volume or margin guidance was provided in the report regarding the Singapore exports, how should we quantify the financial impact of utilizing already built capacity for a new related party export channel?
We quantify it by looking at factory utilization rates. As we discussed earlier, the fixed operating costs of the physical machinery are static. By redirecting the Singapore manufacturing volume to the Malaysian brewery, the subsidiary adds new production volume to the exact same physical machinery.
Right.
This directly improves their factory utilization rate. Because they are distributing the static fixed costs over a larger total number of brewed units, the average fixed cost per individual unit mathematically drops. This improves the operational efficiency of the facility.
Okay, so their future growth depends heavily on physically manufacturing these export units to lower their average costs. But before we project too far into the future, we have to look at their current state based on the framework. Which leads us to part 4, business phase key metrics.
Right. The analyst scores the company in what they call phase 5, capital return.
The phase.
Yes. And there is a clear negative indicator for this phase. The 3-year revenue compound annual growth rate, or CAGR, is negative 0.67%.
So revenue is mathematically shrinking over a multi-year period.
Exactly. But there are very strong positive indicators as well. Their free cash flow to net income ratio is exceptionally high at 86.7%, and their EBIT to interest expense ratio is 54.0x.
Okay, so here's the obvious question. How does a company continuously return nearly 100% of its earnings as capital to shareholders when its 3-year revenue CAGR is literally shrinking?
You have to look at the literal cash flow mechanics of a mature infrastructure. The physical factory and the distribution networks are mature. They require minimal ongoing capital expenditure, or CapEx, just for maintenance.
Right.
Because there's no requirement to physically build new factories, the vast majority of their net income physically converts directly into free cash flow in their bank account.
I see.
This allows them to authorize continuous cash dividends, regardless of the top-line revenue shrinkage, simply because their capital retention needs are so low. However, the analyst notes a critical watch point here.
What's the watch point?
It is the Q3 FY 2026 quarterly revenue compared to the prior year. If the top line shrinks too much, eventually the absolute value of the net income will drop to a point where there isn't enough cash to sustain the dividend.
And that shrinking revenue brings us straight to the specific external threats causing these volume declines. Let's move to Part 5, risk analysis.
Okay.
The report categorizes their disruption risk as high, and the data here is just wild. Illicit untaxed beer constitutes 25% of the physical market volume in Malaysia.
It's a massive percentage.
And the report notes this results in 1.2 billion ringgit in lost government tax revenue.
And additionally, they categorize outside forces risk as high. Malaysia has among the highest alcohol excise duties globally. And those duties were raised by 10% to 192.50 ringgit per liter on November 1st, 2025.
Wow. Okay, so 192.50 ringgit per liter in tax. But then their competition risk is categorized as low because the duopoly is stable. The HLIB analysis projects Carlsberg volume to grow 0.9%, while Heineken volume drops 1.0% in FY 2026.
Right. The legal competitors are just trading small fractions of volume.
Exactly. But the report states that the government's November 2025 tax hike literally subsidizes the untaxed illicit competitor. Can you explain the exact mathematics of how a tax on Heineken mathematically benefits the illegal market?
It is entirely driven by the literal price gap equation. When the legal price per liter must rise to cover the new 192.50 ringgit tax, the legal companies have to increase their final retail price.
Right.
But the illicit product does not pay the tax. So the absolute monetary difference between a legal can of beer and an untaxed illicit can widens. This widened monetary gap makes the illicit product mathematically more attractive to a price-sensitive buyer, so it directly transfers physical purchasing volume out of the legal duopoly and into the illicit market.
That makes total sense. The wider the price difference, the more people just buy the illegal product to save money. So if they are losing that much volume to the illegal market, I have to ask if this threatens the immediate solvency of the company. We need to review their financial foundation, which brings us to Part 6, balance sheet red flags.
Yes, and the framework tests 5 specific red flags on the balance sheet.
Yeah.
And Heineken Malaysia triggers 0 of them.
0. Okay, let's look at the specific line items. Intangible assets are only 25.5 million ringgit, which is just 2.0% of total assets. So there's no bloated goodwill on the books.
Correct.
Their receivables fell 25.4%. And the report notes this aligns with the trailing 12 months, or TTM, revenue decline of 2.61%. So distributors aren't taking longer to pay, they're just buying less volume.
Exactly.
And the company holds a net cash position of 118.1 million ringgit, having fully repaid all 150 million ringgit of their borrowings in Q2 FY 2026.
They are entirely debt-free.
Okay, so the balance sheet is structurally sound. They have cash and 0 debt, which requires us to look at how the market is pricing these stable financials against the reality of falling revenues. This is Part 7, valuation metrics.
Right. For a business in Phase 5, the primary valuation metric is the price to earnings, or PE, ratio. The trailing PE is 12.45x, and that is based on the August 17 stock price of 16.86 ringgit. However, the forward PE is derived at approximately 14.2 based on consensus FY 2026 EPS of 1.19 ringgit.
Wait, let's look at those two numbers. The forward PE of 14.2 is mathematically higher than the trailing PE of 12.45.
Yes.
What exact market expectation does an inverted PE ratio communicate to investors?
An inverted PE ratio explicitly signals a mathematical expectation of shrinking earnings. The ratio is the price divided by the earnings. If the price stays the same, but the multiple goes up from 12.45 to 14.2, the denominator, which is the earnings, must be decreasing. But the market is pricing the stock based on the consensus that the future net profit will be definitively lower than the past net profit.
And the report also lists the price to free cash flow at approximately 9.2x, and the trailing dividend yield is 9.02%. But the analyst puts a very clear red flag warning on these valuation multiples, right?
Yes. The analyst emphasizes that if revenue declines at double digits for a second consecutive half year, traditional multiples must be entirely ignored. You cannot accurately value a rapidly contracting physical business using historical earnings ratios.
Okay, so if the consensus mathematically expects a contraction, we need to examine exact market sentiment and target prices. Let's move to Part 8, price and sentiment.
The 12-month outlook in the framework is neutral. The stock price of 16.86 ringgit is down 33.4% from its 52-week high.
Wow, 33.4% down.
Yes, and this is while the broader FBM KLCI index is actually up 10.43% over the same period.
So they are missing the market rally completely, and the consensus target price has been cut by 18%, down to 22.11 ringgit. Analysts are listed as neutral, but investors are bearish. And the RSI, the Relative Strength Index over 14 days, is at 17.6, which mathematically indicates an oversold status. But I want to focus on that target price. Analysts have cut their target to 22.11 ringgit, but that target is still significantly higher than the current 16.86 ringgit trading price. Why are investors entirely bearish when the analysts project an actual mathematical upside?
It involves the literal mechanics of market catalysts. Investors are refusing to commit capital based solely on analyst spreadsheets. They are waiting for the exact Q3 FY 2026 results, which come out in November 2026.
Okay, so they are waiting for the next data release.
Yes, they need to mathematically measure the physical volume impact of the Singapore exports we discussed, as well as the sales volume from the World Cup. Until they see the numerical proof that those events generated actual revenue, they will remain bearish, regardless of the target price.
So they want to see the literal numbers on the income statement first. Okay, so pivoting from financial sentiment, let's look at technological vulnerability. We have Part 9, AI disruption resistance. We need to examine if external tech changes pose a threat to this physical business model.
The framework categorizes the business as robust and anti-fragile against AI disruption.
Okay.
There is zero AI output in the physical malt beverage itself.
Right.
This entirely eliminates the generative hallucination risks you see in software companies. The primary operational risk is physical food safety, which is managed strictly by HACCP certification at the factory. Furthermore, their revenue is strictly based on the sale of a physical unit, not software seats or digital data subscriptions.
But the report notes there is no proprietary data to defend and also no accuracy premium gained from AI. Is the total lack of digital data gravity a long-term strategic weakness in modern consumer goods?
In this specific case, no, because a business is totally inseparable from the physical machinery at the Sunjai Way Brewery and the physical national distribution network.
Ah, okay.
Its barriers to entry are strictly physical manufacturing constraints and regulatory licensing. The marginal costs of producing each physical unit are high. Software disruption cannot bypass the physical reality of brewing and transporting liquid.
So external software disruption is highly unlikely because of the physical realities of the product. That means we have to look internally at the actions of the people running the company. Let's move to Part 10, Insider, Super Investor, and Buyback Activity. The data here is very clear. Over the trailing 12 months, there were 0 share repurchases. The company has maintained a constant share count of 302.1 million shares since FY 2021. And there is 0 insider buying activity.
0 across the board.
In most equity analyses, an absolute absence of insider buying and 0 share buybacks over multiple years is interpreted as a severe lack of internal confidence. But the report instructs us to explicitly not read this as bearish. Why does the analyst say that?
Because you have to directly analyze the corporate structure of the entity. 51% of the shares are controlled by GAPL, which is the parent entity.
Okay.
Because the parent company maintains majority control, the local executives are salaried career managers. They are not founder-owners executing personal equity accumulation strategies.
Right, so they aren't incentivized to buy stock the same way a founder would be. And what about the buybacks? Why no share buybacks?
That goes back to the mathematical reality of returning approximately 100% of their earnings as cash dividends. Because they distribute all their net income as dividends to satisfy the parent company, there is 0 retained capital left in the accounts to physically execute share buybacks. It is a strict structural limitation, not an indicator of management sentiment.
Okay, that makes perfect sense. It's just the mechanical reality of how the cash is distributed. So to summarize the strict, literal realities we have uncovered today, we have a structurally advantaged duopolist. They are facing severe volume declines from tax-induced illicit competition.
Yes.
But they are sustained primarily by their ability to immediately convert net income into cash dividends because of their mature physical infrastructure.
That is an exact summary of the mechanics.
Thank you for joining this deep dive. And to our listeners, keep questioning the literal mechanics behind the balance sheets. We will see you next time.